Good morning, ladies and gentlemen, and welcome to the inaugural presentation of NCCPAP Now, a way for you as NCCPAP members and guests to find out what is going on both within the organization and in the tax professional community. I am Neil Fishman, Chair of the Public Relations Committee, and I will be acting as your host for today. Since this is our first program, there may be a few bugs, so please be patient and understanding if they occur. This is new for all of us. Anyway, before we begin, we do have a few housekeeping matters that we do need to take care of. So first of all, if you have any questions regarding your CPE, you can contact the national office, Alexandra, and you can see her email there, execdir@ncpap.org, and her phone number, the office phone number, which is 516-333-8282. In order to get your CPE credit for this program, there will be 4 polling questions. You need to answer all 4 of these polling questions in order to get your credit. In addition, once the program is over, you will be sent to give a course evaluation where we will be asking for comments on the program and, of course, any suggestions you might have to make the program better. If you do have any questions regarding the presentations, we please ask you to use the Q&A at the bottom of your screen. Some of these questions we will answer right away if possible. Other questions will be answered during the program. And if we don't get to your question, it will be answered afterwards, after the program ends. So, and lastly, as you can see, this program is being recorded. So the recording of this program and the PowerPoint handout that you will be seeing on the screen will be sent to you also after the program ends. So moving on to that, we will go right away to our first presentation. And for that, Mark Stewart is starting his 2nd year as president of NCCPAP, and he will be talking about issues affecting our profession. So Mr. Stewart, please go ahead.
And Neil, thank you very much. Folks, in the spirit of starting a dialogue amongst the members, we want to bring, hot button issues that start a discussion amongst members. It will, of course, be us giving high-level information to you that is meant to spur talk, dialogue, questions amongst yourselves. So don't view this as an end-all to the discussion, but the beginning of a discussion amongst members. Now, one issue that's out there, and it's going to really be the only issue that I covered today because it's that important, is beneficial ownership information reporting. Now, this issue will be new to a lot of you, all right? A lot of you have not necessarily heard about this, although I did read the NCCPAP on the Go discussion board this morning, and the first post was, when is it going to be an update about the Corporate Transparency Act? So for that member, here you go. Don't say we don't deliver. Asking you shall receive in the same day. So this beneficial ownership information reporting arises from the implementation of the Corporate Transparency Act, as I mentioned before, which was enacted as part of the Anti-Money Laundering Act of 2020 within the National Defense Authorization Act for fiscal year 2021. Now, folks, I know that that's a mouthful. It's really not necessarily important where it originated from, but it is, some good background for you guys to at least know kind of where it generated from as a general idea of it. Now, this reporting goes through FinCEN, the same folks that brought you FBAR reporting. All right, so this is not IRS reporting. This is FinCEN reporting. Now, FinCEN, as you know, is in part an anti-crime unit. So not complying with these requirements not only potentially has heavy fines, but also potential imprisonment if it's found to be willful. So it's good to scare you guys first thing in the morning into paying attention, but this is why you have to pay attention. This is going to be vitally important for your clients. Now, who has to file these beneficial ownership information reports about their owners? Well, the definition is actually very broad and encompassing. It's defined as a reporting company, includes, a corporation, limited liability company, or any other entity created by filing a document with a Secretary of State or similar office in their state. So essentially, any formed incorporated entity. Now, there are exceptions to this. However, I don't want anybody to get excited. The exceptions I'm going to show you on the next slide are not going to apply to most NCCPAP members and their clients that they service. So the exceptions, PCAOB registered firms are an exception. As NCCPAP members with the clientele that we're dealing with, we, for the most part, do not deal in that. But just so you know, PCAOB registered firms are giving exemptions to this because they already have to disclose a lot of information about their ownership. The second category of exceptions, the businesses that do not have to file this report, are what's known as large operating companies. But large operating companies are companies that have more than $5 million in gross receipts and more than 20 full-time equivalent employees. So again, I know a lot of members at NCCPAP deal with very small businesses. So for the most part, most of the clients that we deal with are going to be stuck with this type of reporting. Most of our clients are under these limitations. Now, what we don't know yet is if the IRC control group rules are going to come into play here. You know, a construction company, he splits it into two for the different construction projects, and the two companies together as a controlled group are over 5 million and over 20 employees. We don't know yet if they're going to exempt people as controlled groups. If you wanted my guess, I'd be surprised if they do. The idea here is to find out as much about ownership in the country as possible of businesses. Remember, this is an anti-money laundering law that they're trying to enforce here, and they're trying to find out information about businesses to prevent money laundering. And again, that's the driving force behind what's going on here. So don't anticipate too much relief coming here to exempt more companies. If anything, they're going to try to be more inclusive of the companies that are going to be under these requirements. Now, here's what's going to kind of get scary, guys. I'm going to talk later about who's considered the beneficial owner. But for anybody that is considered a beneficial owner of a company, they're going to have to be disclosed. What's going to have to be disclosed about them? Full name, all right, easy enough. But now we get more difficult. Date of birth. We don't necessarily know the dates of birth of the owners of the companies we prepare tax returns for. In fact, we very rarely know their dates of birth. Next item, their tax residency address. Now I stress on that slide, not their mailing address, their tax residency address. So if you have, owner information, K1 information, that lists PO boxes on it, and you're going to try to use that address when you disclose this information on this beneficial ownership information report, not going to suffice. It's going to have to be the tax residency address. You're going to have to get that information. News continues to get worse, folks. You're going to have to also present for these beneficial owners a unique identifying number from a passport, driver's license, or other state-issued ID. By the way, don't ask the question, what if somebody doesn't have one of those types of IDs? FinCEN has not yet announced anything specific as to what happens in that instance. Assuming that the owner does have one of those types of IDs, it will not even be good enough to just disclose the ID number, but the system they're developing will require that you upload a copy of the document showing that number. Now, I want to stop here, guys. Think about how much information you're going to have to gather about the owners of these companies here. And we're sitting right now at the precipice of tax season starting, really has already started for most of us. And this is really the only time of year often that we touch with certain business clients that are non-recurring engagements. So if we know this is coming down the pike, and I'll give you the timeline in a second, you might want to talk to these business owners now about these requirements and gather this information as part of the regular year-end tax return preparation gathering process. And start gathering that information now rather than later. Now, when these reports are due. So the first kind of group, all companies that are in existence as of FinCEN issuing their final regs, which we anticipate is going to be roughly around the summer of 2022, but they haven't yet announced that. But all companies in existence as of that time will have 1 year to file this report. That's not too bad. That gives us a year to work on and get the information together. Although annoying, not the end of the world. But it's not all good news. Any new company, second bullet point here, in existence after when FinCEN publishes these rules, will have to file this report within 14 days of formation. Now think about your clients. Your clients often come to you months after forming a new entity and say, hey, Mark, hey, Neil, hey, Steve, I formed a new entity. Tell me what I have to do. They're already going to be past the 14-day requirement. So you're going to have to kind of talk to the clients you already know and tell them how important it is that literally the day after you form, you have to tell us that you formed so we can get these beneficial ownership reports in as soon as possible. News gets worse. Any changes to a previously filed report will require an updated report to be filed within 30 days of the change. So there's the obvious things about if owners change, new owners, retired owners, et cetera, so forth. That's easy enough, usually assuming a client tells you about it. But also any change in an address of a beneficial owner must be reported within 30 days. We very often never find that information, or sometimes we find it out years later. We're told, hey, the address on the K1 was wrong 2 years ago, change it going forward. So this is going to be a whole new dialogue you have to start with your clients about keeping you updated with filing these reports. Because keep in mind, although I know, guys, these reports seem like, hey, they're really something more that an attorney should do or something like that. You know that your clients are going to come to you to do these reports. So we're going to be stuck doing this in the same way FBARs, for example, have become our responsibility over the years. Now, here's the important part. So I told you what companies are required to file these reports. So now it's when you're required to file these reports, what types of owners are required to file these reports? Excuse me, what types of owners are required to be disclosed by a company in these reports? So the easy one, any more than 25% owner is required. But it didn't make it that simple. Outside of more than 25% owners, anyone who is deemed to have substantial control of the company, which is broadly defined, as I'll get into on the next slide, will be required to be disclosed. So you won't just be able to look at a tax return, pick up who has more than 25% ownership interest, and go from there. There's much more to it than that. So who else is defined as having substantial control? Any senior officer at a company. Anybody who can make a change to the board of directors. Bullet point 3, anybody that can transfer assets, control expenditures, change the line of business. Just think about this, folks, guys. This could be anything from a senior officer to your bookkeeper that has control of these things, would be required to be disclosed as a substantial owner, substantial control owner, a beneficial owner, have to be disclosed in this report. And also, they list at the very end, any other form of substantial control that FinCEN might add on later on. So this gets very scary very quickly, folks, when you think about the tentacles here, about what might be going on. Some other things to consider. What if a trust has ownership of the company? Would the trustee have to be disclosed as having substantial ownership control? Probably. Would beneficiaries of a trust, if they're the sole beneficiary of the trust, have control? Probably. Would persons that are deemed owners by attribution rules, for example, you're in a community property state and a spouse is involved, but they're not the direct owner of the company, they are probably, okay, considered a substantial control beneficial owner. And Bob Brown, I saw your comment in the chat. These are not proposed. This is actual rules coming down the pike. FinCEN is now just fine-tuning the edges of this, but these are proposed rules, and I get into my next slide, but they're going to be mostly final. So what can we do about this? I know I covered a lot in 15 minutes. I could speak about this for hours. Comment letters are being accepted into February 7, 2022 on this issue. I provided on the slides there, which we'll provide to you. You can write in on this by mail, or they made a portal to write in about this. You're going to want to submit comment letters about this. All right. There is a lot going on here, and this is going to be a tremendous burden on us as a profession to help our clients file this report. So I know I zoomed, no pun intended, through this very quickly. We can do an hour, 10 hours on this. We probably will have to do future presentations on this, but that gives you an overlying view of what's going on, so you can start having a dialogue with your fellow practitioners and your clients. So I believe now, Neil, we'll move on to any Q&A that folks might have.
And yes, we do have a few questions for you. And the first question that has been posted was, does that include broker-dealers that are registered with the PCAOB?
Yes, so right now, the way the rules are currently constituted, anybody registered for any reason with the PCAOB is excluded. But again, stay tuned, because they are issuing the finely tuned regulations probably in the summer of this year, after they review all the comment letters they receive by the first week of February.
Okay, the next question is, will they be requesting ownership info under related party member owners? So for example, if one spouse owns the company, do we have to report the other spouse? And what about other related parties?
Yes, so actually, it was actually, Andrea, you might have asked that just before I got to my last slide. The answer is we don't know, but probably yes, because there's a catch-all provision at the end of this where FinCEN says, we know we set all these rules, and also anything else that you deem in your mind's eye substantial control of a company, you need to disclose that owner. And kind of like I tell people about foreign asset disclosure, when these reports come out, we have to file these. My suggestion would be, if you think somebody has substantial control, disclose it. You're never going to have an issue getting in trouble with FinCEN because you over-disclosed, only if you under-disclosed. So when in doubt, disclose.
Okay, two more quick questions. When you specified before, what is tax residency address? Is that by state or your physical home address?
So they want to know what state right now, the way it reads, you're listing for where you file your resident tax return.
And then lastly is that you stated that once these rules go into effect, existing business entities will have up to a year to report it. But if somebody starts a brand new business just a few days after this goes into effect, they only have 14.
They have 14 days. That's it. I know that sounds crazy, but those are the rules as currently constituted.
Well, we've always been in the middle between the government and our clients. I guess that will just continue on. So Mark, I want to thank you very much for this presentation. Okay, so moving on. As most people here are aware, the IRS's outreach to the practitioner community is the National Public Liaison's Office, known by the acronym NPL. NCCPAP is an active friend with the NPL department at the IRS. They have meetings practically every month, letting us know what's going on within the IRS. When these meetings are held live, we have a representative there. Currently, that is Steve Mankowski, who is one of the co-chairs of our tax policy committee. And I'm now going to ask Steve to take a few minutes to talk about what's going on in Washington. So if you please, Steve, the microphone is yours.
Good morning, Neil, and thanks for all those in the NCCPAP members, as well as any guests that are in attendance today, for taking time out of your day to log on and hear a little bit of what's going on.
Steve, I'm
Yes,
sorry,
sir.
just one thing I forgot to say. If anyone has their name listed as anonymous or by their phone number, they will not be getting credit. You must have your first and last name appearing on your screen. Thank you. My apologies, Steve. Go ahead.
That's all right, Neil. Just as I get started, just 2 quick points, just as one who, besides participating in NPL, I also participate in the Commissioner Security Summit. I'm sure most of us at this point have renewed our PTINs for the upcoming filing season. If you haven't, you really should be getting that handled quickly. While you're logging on for that, it's also a good time to check the number of returns prepared under your PTIN. And you probably should also look at the same under your EFIN as well to just verify the number of returns to make sure that it's reasonable with what you've prepared. It could be a sign, if the numbers are vastly different, that you may have a potential breach within your operating systems, and that needs to be reported and handled quickly before it gets significantly worse. So now moving on to my presentation, the infrastructure bill. The infrastructure bill, otherwise known as Infrastructure Investment and Jobs Act, was signed into law by the President on November 15th of 2021. 2 primary items that came out of this bill were, one, it was resulted in the early termination of the employee retention credit to be September 30th of 2021 rather than the end of the calendar year, as well as changing some information on how digital assets are going to ultimately get reported. For ERC, ERC was implemented under the CARES Act, extended by the American Rescue Plan Act, and again, it was terminated as of September 30th of 2021. The credit itself is up to $7,000 per qualifying employee per quarter. The only change that didn't come into effect with this is if your company was deemed as a recovery startup company, and that's not necessarily for us, but any of our clients, they were not part of the early termination. They're still eligible to receive up to $50,000 per quarter number 3 and quarter number 4. Moving quickly on to the informational reporting for digital assets. They changed the definition of digital assets slightly to be defined as any digital representation of value that's recorded on a cryptographically secured distributed ledger or similar technology. Quite a handful. Basically, it's talking about items that could be reported on the blockchain. And it also could include what's referred to as non-fungible tokens or NFTs. They've also expanded the definition of broker to include digital assets. That's key because much of what has been the bane of our reporting of how we report any of the sales of cryptocurrencies, digital assets, or whatever buzzwords you want to use, this is now going to start making the brokers have much more responsibility in how that information gets reported into on their end of year statements, which ultimately helps our reporting of any of their transactions. Also, the reporters, it's going to require brokers to report cost basis for digital assets to non-brokers, basically items being transferred out to some of the various virtual currency wallets. Any of the transactions that are greater than $10,000 are deemed as cash transactions and will require Form 8300 for payments or a group of payments totaling over $10,000 to be reported on Form 8300. That's a very key change, and it's one that you certainly want to keep in mind, as I'm sure each of us are having more and more clients that are trading in virtual currencies, and keeping in mind that the questions that have been added on to the 1040 have been changing both in the substance as well as location on the 1040 or any of the supporting schedules. Now it's actually on the body of the 1040, asking if you had sold any assets during the year that you need to report. It's a very key to make sure, because the IRS does have this on their radar. Probably 2 years ago now, Neil Fishman and I attended a summit on virtual currency at IRS headquarters, and they've really been boosting what they've been doing as far as their enforcement. They've been sending out multiple soft to hard letters for taxpayers who they're seeing that have had significant trading in virtual currencies. Either, hey, you may want to look to talk about reporting, to basically file an amended return, or we're going to come down a lot harder on you. With the changes that came in from the Infrastructure Act, that's going to be effective for returns and statements that are required to be filed after December 31st, 2023. It's still vague in the wording whether that's going to include 1099s that are going to be filed in January of 2024, or that would relate to the 2023 tax returns, or simply returns that would be filed starting in 2024. The IRS is expected to provide guidance on that at some point prior to the effective date. But just keeping in mind, again, the IRS is tracking much more virtual currencies. They've been getting data from a lot of the different exchanges and a lot of the different wallets. So that information is becoming more and more prevalent. And it's certainly a question that each of us, as we're going through our tax returns with our clients, need to make sure if we aren't already doing so, that we're asking the question of if they have virtual currency transactions, and make sure that we report them accordingly. And just as people are responding, there is a question that came into the Q&A about how to check the number of returns on your PTINs. You would actually go in as if you were renewing your PTIN, and there is a location there to actually go through and see the number of returns that were filed for the last several years under your PTIN. And I do believe it's broken out between individual returns and the corporate returns. And the same as different login, but obviously the same for going through with your EFIN. Now moving forward, next topic just to cover briefly is going to be the advanced child tax credits and economic impact payments, number 3. Last year we had the 8812 that we would record in the reconciliation for the economic impact payments. That schedule's been reformatted now to also include the reconciliation for the advanced child tax care payments. And the result from that reconciliation will go on to line 19. There's pending legislation that could extend the credits into 2022. As of today, there's nothing that I've seen nor heard that pertains to this, but there's still the Build Back Better and the reconciliation bills that are pending, and it may be included in one of those. And it's certainly one that, if that does get passed, NCCPAP will be sending out an update to blast all of our members, letting them know. Many of our clients, and if it pertains to you with children, are receiving letter 6419. They started going out in late December, and it's a statement that's outlining the payments as well as the qualifying children that receive the advanced child tax credits. And my understanding is that for taxpayers, that if it's husband and wife, that the data will need to be combined, and keeping in mind that it's based off of the last filed tax return for the payments. So it is possible that the wrong parent may have received payments if they didn't go in to make changes into the IRS portal. Any children born during 2021, unless they made changes, have not received those credits and would be part of the reconciliation. And similar to the economic impact payments last year, the advanced child tax credits were not subject to any type of offset. However, as we know, when filing the tax return, if there is any tax offsets, be it for any installment payments, delinquent child care payments as such, the tax refunds are subject to offset. These credits were not. So just keeping in mind, just to summarize this, there will be a reconciliation on Schedule 8812 going to line 19 and making sure that your clients provide a copy of letter or letters 6419 to aid in preparing your tax return. For the economic impact payment, the third payment was received, I believe, January, February timeframe of 2021. At that point, all of the taxpayers received a letter 1444C. The first letter with the first payment was 1444. Payment number 2 was 1444B. It was received somewhere around the same time as the payment was received. Knowing that the issues that we had last filing season, the IRS has come up with letter 6418, which is being sent out in January, providing the details of EIP number 3. And as noted before, with the restructured 8812, this reconciliation will also go on, be prepared on that schedule, and the result will go to line 30, similar to what we had last year. And at that point, time for any Q&As, Neil?
Yes, well, thank you, Steve. Well, we do have a couple, I apologize, but we do have a couple of questions that are going back to Mark's presentation, which I think need to be addressed right now. So the first one is, and I've seen this in the chat as well, people are asking about the response on BOI to FinCEN. They're wanting to know if they should do it directly themselves, or should they be doing that, sending that to NCCPAP, who will then be sending a collection of comments?
Yeah. So the answer is actually both, because there's power in numbers. So we do suggest that you craft your own letter that you write with your specific issues, and then send that letter to us. Or if you're not comfortable sending a letter, you can just send some brief bullet points to us. For us as NCCPAP to issue a consolidated comment letter. But I think it's better if we speak in numbers, and not only does NCCPAP issue a comment letter, but also you as individual firms issue comment letters as well.
Okay, and then one more question for you, Mark. If FinCEN is going to be the authority to whom this information will be reported to, will FinCEN require a separate ID like a PTIN for tax returns?
So unfortunately, Evan, and good to see you again, Evan, at least virtually. Evan, this is one of those situations where I think I mentioned before, the analogy is they are literally building the plane as they're flying it. So right now, some of the specifics about how you file, how you log in, under what ID number, that sort of thing, they've worked none of that out yet, unfortunately. So unfortunately, Evan, that's a stay tuned on that.
Thank you very much, Mark. Okay, so Steve, I want to thank you for your presentation. It is very important that NCCPAP is a working member with the IRS to hear about these issues as they come up. Having previously also attended these meetings, it is very important that we know, because sometimes the people at these meetings find out ahead of time what is going on at the IRS before the general population does, before the rest of the practitioner community knows what's going on. It's great to have a heads up. And so again, Steve, thank you very much for your time in attending the MPO meetings and disseminating the information to NCCPAP and its membership.
Thank you, Neil.
And our last segment, we will be choosing one chapter to highlight what's going on within their area, within their community. And for this initial meeting, we have chosen our brethren in Texas. Frank Sands, who is our Executive Vice President, is also President of TACPA, which is the Texas Association of CPAs. So without any further delay, Mr. Sands.
Thank you, Neil. I appreciate the opportunity to talk to y'all and let you know what's kind of happening here in the state of Texas. The first item I'd like to talk about is the hot issues coming out of the Texas State Board of Public Accountancy. Right now, they're working on the new uniform CPA exam. And this was a result of the CPA Evolution Initiative, which was undertaken by the National Association of State Boards of Accountancy and the AICPA. Now you can look in the Journal of Accountancy for a few articles that explains what this initiative is. It has to do with both the education at the college and university level and the CPA exam itself. Major changes we have now are, there are now 6 sections of the CPA exam. We used to have 4. 3 of these sections are considered core sections. That's the auditing, financial accounting, and tax and regulations. The other 3 sections are more pointed towards certain disciplines. And of those 3 sections, the CPA candidate has the ability to choose which one they want to take. Essentially, that means you still got 4 parts to pass in the exam, but you get a choice. Texas State Board of Public Accountancy has a rules committee, and they are the body which sets the rules for this CPA exam. What happens is they promote this thing to the state board, then the board goes ahead and adopts the recommended rules. It goes to the Texas Registry for comment, and then after that, it becomes the rule of the Public Accountancy Act in Texas. The definitions that the state board is looking at right now have to do with independent study, internship, qualified accounting courses, and effective ethics. Independent study is something that's designed by the student, approved by the college and university, and supervised. Internships are approved and supervised by the college and university. Qualified accounting course definitions will change effective 1/1/24, and this will match the new uniform CPA exam blueprint that came about from the initiative we discussed earlier. Another important thing here is that ethics is going to include AICPA ethics, SEC ethics, and the board ethics. Now, this means that ethics rules could change depending upon what state you're in. So it's a good idea to keep an eye on those things. Most states will adopt the AICPA's lead in this, but there's no guarantee. The requirement is still 150 hours, and you can see that ethics is 3, independent studies 3, and there's 2 forms of internship, accounting and business. That's for 6 hours. The important part here is that in Texas, the state board says they may accept 3 semester hours of independent study, which means that you probably better get that thing approved before you go ahead and do it. I reached out to Texas Association members to kind of get a poll of what's on their minds right now and what's important to them in their practices. And I got some interesting responses, most of which aligned with the concerns that I've heard expressed in my association with NCCPAP. Right now in Texas, only 25% of our licensed firms are subject to peer review, which means that only 25% of them are doing the test functions. So what is the problem here? Well, it leads to higher costs for the services for the public. It creates problems in the timely rendition of these services. And it also creates problems in the availability of the test service. There's only 2,000 some firms doing it, and you need it, and you're in Texas, you may have trouble finding one to do it. Another concern of those that I talked to have to do with peer review issues and some other issues. Peer review, regulator involvement in peer review is a concern. The AICPA has expressed this. They're kind of nervous that if they don't get this peer review thing done well, that the state and federal regulators will get involved. And that's probably an outcome none of us want to see. We also know there's a shortage of reviewers. And that makes it a problem getting them done and to be able to comply with all the requirements. There is a opinion, or for lack of a better term, perception that these reviews are largely punitive and have ceased to be educational or helpful in their application. Some of my members also explained have concerns about what is the difference between compilation and preparation of financial statements. It seems like it goes to what's reported and not necessarily what work goes on behind the scenes in order to get this done. So we would like to have some explanation there, and perhaps in the future we will speak more of that. Our members down here are also concerned with the aging CPA population. We have population replenishment issues. In other words, we don't have enough young people coming into the profession in order to fill all the needs. And that makes recruitment hard. That makes employee retention difficult. It affects firm marketability. In other words, how can you attract staff to your firm? In the case of the aging population, if you're looking to move out and retire, what's your result? You're going to sell it? You're going to do a merger to retire? It makes it difficult if there's not enough people out there that are willing to do the work. So it leaves us with a lot of questions, and I know this has been quick, but it's an idea of what's on the minds of our people here in Texas. And I'd like to open it up to Q&A at this point.
Okay, well, Frank, we do have a question. Does Texas have mobility?
Yes.
Okay, another question, another person wrote the comment. I don't think it's just Texas. Aren't we all having issues with peer review, finding additional employees, and getting younger people involved in the profession?
I would agree. In my interaction with other folks in NCCPAP, from New England all the way down to Florida and points in between, they all have expressed concerns about these peer review issues. So here in Texas, we're not any different than any of the rest of y'all.
Okay. One thing that I'm sorry. Okay, well, thank you, Frank. That was the only questions that we had for you at this time. I did, ladies and gentlemen, I did take a look at the attendees, and there are a few of you who do not have your actual names on there. It is important that we have your first and last name on there so that when we compilate the polling questions, we can give you your CPE credit. If we don't have your name, we cannot give it to you. I do apologize. Steve, you have a comment you want to make? Steve Mankowski?
No, sir.
Somebody just, I'm sorry, Frank, someone just posted another question is, are you sure about mobility? I had an audit in Texas and they wanted me to go through a difficult process.
from what I understand, yes, they have mobility and reciprocity. But as typical with the Texas State Board, they still like to maintain a certain amount of control over the final decisions on those issues. I am not involved in the audit aspects of public accounting, so I can't speak to specifics there. But I do know that if you're having an issue and you call the state board and express their issue, they've been in the past very helpful in guiding you through any problems that you may have in getting your needed result.
Okay, thank you, Frank. Somebody made a comment in Q&A that peer review has divided the license you now have to choose. I'm not sure if anybody on our panel can answer that question or comment on that question. Mark or Steve?
Yeah, I'm not, Angela, I apologize. I'm not sure what you're driving at specifically. If maybe you can email the question to one of us later in more detail, perhaps we can answer it for you.
And we do have one final question. And this is specifically to you, Mark. Could you please address if NCCPAP will be going to Capitol Hill this spring?
Yes, and anonymous attendee who actually read my mind because we were going there next. So yes, folks, the plan is to visit with legislators and or the IRS at our May meetings. Now, what form that will take, we don't know. As you know, it's kind of out of our control right now, whether things will be done virtual or in person. So stay tuned on that. But whether they be virtual or in person, we will be having meetings in DC this year. Now, as we always tell you guys, there will be a ton of issues that face you as tax season comes along, issues that we can't even predict right now. We encourage you to, just take a second out of your day, at the end of your day as it's happening, and just jot down the side what those issues are and shoot a quick message to our national office. Doesn't have to be a long message. It could be one sentence. This is an issue affecting me. Please bring it to DC. As importantly as bringing issues to us, folks, we always like to see new people and new faces when we meet with legislators in DC. It's always a good learning experience for younger members and younger CPAs.
Excuse me,
So,
Mark, polling
yes.
question number 4 has launched,
Thank you,
Thank
Steve.
you,
just so
Steve.
people are aware.
So it's always a good learning experience. It's always enlightening to see different perspectives, not only from your own members of NCCPAP that are attending the meetings, but also as you talk with the legislators and their aides. So anybody that's interested just in participating in the talks during the meetings, just send the message to our national office. Those of you that know me, obviously, you can message me directly and just say, hey, you want to participate? Bring the issue, and we'll certainly do our best to incorporate you into the meetings. Neil, I did want to comment as there is some stuff also in the chat in reference to my presentation. One of the members, actually I saw 2 different members make a comment about liability for CPAs when it comes to this. And the answer to your question is, well, yes, and let me take it from several standpoints. It's going to be very hard as CPAs, because you're going to be doing this for some of your clients, this beneficial ownership information reporting. If you do it for one of your clients and don't do it for another one of your clients, and that client gets dinged, the question on that client is going to be, why did you do it for one client and not for another client? So some things to consider. One, as this comes forth, I would recommend speaking to your insurance providers about drafting separate engagement letters for this. Now, I know we're all sick of separate engagement letters, but I think something like this is going to require a separate engagement letter that specifically details and limits what our liability is as a CPA or as a firm. That's going to be very important when it comes to things that carry penalties of fine and or imprisonment. And the latest rumors on that are not final, is that there'll be maximum fines of $10,000, maximum imprisonment for those found in willful neglect of 2 years. So that's harsh stuff, folks. So I think when it comes to doing these things, client wants us to do it. I don't think it should be under a current retainer or whatever agreement you have with them. I think it has to be a separate engagement.
Okay. Thank you very much, Mark. On behalf of Mark Stewart, Steve Mankowski, and Frank Sands, I'm Neil Fishman. We thank you all for attending, and we look forward to seeing you all on February 28th.